The real reason the head of Canada, Tiff Macklem, actually increased interest rates again in June and then again in July. He actually gave a very thorough, in-depth interview with the Globe and Mail, and they kind of printed all his answers out. And I'm going to go through each and every single of you because it kind of gives us a little bit of insight into what he's thinking, and maybe we can try to see what he's planning to do in the future depending on what kind of data comes in. Now, if you're looking for some help on how to navigate the real estate market and want to work with someone who understands some of this crazy monetary policy stuff and want to guide you in the right steps so you make the right move for you and your family, then you can book a call with me using the link that's on the screen right here. It's www.chatwithzen.com. Simply click on a date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and I run and operate a RE/MAX in the Greater Toronto area on top of making awesome educational real estate content just like this one for you. And if you're enjoying the content so far and it's helping you on your real estate journey, then make sure you help me spread the knowledge by smashing the like button and subscribing to the Prime Properties channel. Now, the first and only article we'll be going through is an in-depth kind of analysis of Tiff Macklem, the head of Bank of Canada's interview that he had with the Globe and Mail. So the first one we'll obviously talk about is why did he actually increase rates again? And I'm going to go right into a snippet of what he said in one of the interview questions. And I'm going to go back afterwards, right? So the question they asked is, do you think the pause in January was a mistake? And he says that the January pause made sense. And he thinks it was a prudent thing to do and wants to try to balance the risk from over or under tightening, meaning increasing or decreasing rates too much. And the second thing he said is that a pause is a pause. And we all did say that it was a pause, right? He said it was conditional based on forward-looking data. And he didn't say that he was done. In fact, we were very clear, if we need to get inflation back to 2% target, we will. This is very important. 2% target inflation is what we've had in the last decade or so, maybe even 2 decades if I remember correctly. And they're trying to get it back there. I've always been the proponent of, I don't think we're gonna get back to 2% unless they fudge the numbers. I think they're probably gonna be hovering around 3%, and there's actually indications of this a little bit later in the article. So make sure to stay tuned the rest of the video. Now, the situation in January, we had raised rates from ultra low to 4.5% in a space of 11, and it was the fastest increase in interest rates. So they wanted to let this kind of marinate and see how it happened. And because the economy was still so strong, and the housing market kind of rebounded so quickly, they decided to hike interest rates again in June and July. So that's what they're saying. It made sense to pause to kind of determine what it is. And keep in mind, at the end of July, the latest rate announcement, they didn't say they were done. They said they may be done. They just said that, you know what, let's gonna play it out. But they didn't also talk about any kind of rate increases. So they kind of left it very open-ended. So if we kind of read between the lines, which I'm trying not to do, right? But you can see that there was a lot of pressure for him to increase the rates some more because he kind of let it sit on a bit, and clearly it wasn't going in the direction that he wanted to, right? Now, some of the other questions that are actually very, very interesting for you guys to see is this. So when he was asked, it's fair to say that you and most central banks, you being the head of Bank of Canada, Macklem, have been surprised by what has happened the past 6 months. So that's exactly what we're saying, right? The past 6 months was a surprise upside on the inflation. With the persistence of inflation and economic growth, what is actually going on? So one of his components of this answer was monetary policy, which is what he controls, is working. Inflation has come down a lot from 8.1% last summer to 3.4% now. Great. So he's taking a victory lap. That's perfectly fine, right? Because at some point, if inflation was going at 8% and it goes again, it's a problem. Remember, they're trying to aim for disinflation, not deflation, where they slow down the inflation. Deflation meaning prices are going backwards, right? And he thinks that we're going to be around 3% going forward. So same thing, I agree with him. I've always said that I think because of all the kind of economic things in the global world, I don't think inflation is going to come back down to 2% because of globalization. And he says it's around 3%. And going forward, it's staying around 3%. But keep in mind, in the last sentence, or the last question they asked him, right? He says their target is to get it back to 2%. So that basically tells us that he's not going to be dropping the rates for a long time. He's going to keep trying to push for that 2%, right? So this is why I say what we have right now may be a little bit high, but I don't think it's going to ever go back down to how low it was previously. Now he says, and this is, I think, incredibly interesting, in Canada, we have the added dimension that we have strong levels of immigration. So he doesn't control the level of immigration. The federal government does, the Liberal Party, right? So That's actually helping ease some of the pressures in the labor market, meaning that the new immigrants, temp workers, and even international students now, because they can work 40 hours, are taking some of these open jobs. But at the same time, it's adding demand to the economy. So this is what I was saying. Immigration is inflationary because the people that come here have to spend money and they have to rent homes, right, at the very least, or maybe even buy, which therefore increases the GDP. Immigration is inflationary, but long term, it should be deflationary because there is wage pressures for prices to go up. But if you have new immigrants coming in who are willing to work for a little bit less, or there's more people taking up these jobs, there's no need for the employers to increase the wages, right? So this is why when you compare Canada to US, like our wage growth has been anemic. And when the real estate prices go up and that gap between wages to home prices, it's a bigger and bigger spread, unlike the US, right? So while immigration is great, keep this in mind. One of the reasons why wages don't go up is because of that reason, right? And they're saying that because those new entrants in Canada, they're new consumers, we talked about, they rent apartments, they buy homes, they go shopping like the rest of us, right? So that's kind of contributing to the inflation. Now, here's another interesting one. He says, how important has the extension of the amortization periods that banks have been given of their mortgage clients been, and has that disrupted the transmission of monetary policy? This is super interesting. On the margin, they may be having a little bit of an effect, but frankly, this is what banks always do. And I've said this before. I've heard this from a lot of my clients in the past. If you call in for financial distress, the banks will help you. They're just not publicizing it, right? But he just did, right? So when you've got borrowers that are really squeezed or distressed, the banks, they will work with the borrowers and try to find a solution that works for the borrowers and the bank. Because remember, the collateral, the home that you live in, if it's your home, it's the bank's problem if you don't pay for it. And if that thing's underwater, the banks don't want it back. They're in the business of lending you money, not collecting homes, right? So that's very eye-opening for some people who don't know that. Again, if you're in trouble, they'll go back, right? Again, it was in the budget already, the Canadian budget. So I will not be surprised if more of this stuff comes up, right? Now, here's another snippet that kind of adds on to what I was just talking about, right? So they're saying, in terms of inflation and why Canada needs to allow immigration to come in, because we don't have enough population growth. So I think every couple is 1.6 kids, meaning that we don't replace ourselves. And over here saying that people are retiring, right? We have a really big baby boomer generation. The labor market looks like it could be sort of structurally tighter going forward. Globalization has at least stalled. We talked about this because, China shutting down and all the whole global crisis policy war and all that stuff I'm not going to get into. It doesn't look like it's going to make globalization easier, meaning we can't farm out and get things done for cheaper. And it's not likely to reverse. That could create more cost pressures, meaning inflation. This is why I'm saying prices are going to go up. It's very difficult for us to get down to the 2%. I still think at the best we'll have around 3%. And we're going to need a lot of new investment in cleaner technologies if we're going to meet our emission structure. Look, that's just some climate stuff. I don't think any of this is going to help with inflation. If anything, climate's going to increase inflation. But anyways, I don't want to digress. Now, here's another one about housing. How worried are you about out to the 2025 and 2026 when you start seeing all these mortgages that have amortizations extending snap back to their original payment schedule? So I found this very interesting. He says he's built out the negative amortizations into their models, but there's always some uncertainties of how much it will have effect. And for some households, it is going to be difficult, which obviously we're hearing a lot of people that are going to struggle already with the Scotia floating rate. But for many households, they have built up enough equity in their home. They probably have gotten a raise over that period. I don't know what raise he is getting, unless you're working for the public sector. Nobody's getting that kind of raise to cover that kind of interest rate hike. And their incomes will be higher. But most people will be able to manage. So his forecasts and his models are all predicting that this negative amortization thing is going to be okay. People will fix itself, or people will be able to make do. So that's what he is saying. I tended to agree with him. I said, I think a few weeks ago, I think the amortization rule is a little bit blown up because people have time to kind of fix it, or if they really need to kind of liquidate, they can liquidate, right? So do people have that option? I don't think we're going to get a huge flood of listings that people think we're going to get in 2025 and 2026. Now, the risk from a Canadian perspective, if there was a global recession, if Canada goes into a recession, unemployment goes up, meaning people have no money to pay for even just the interest rates on these negative amortizations, that will make for a much more difficult when people have to reset their mortgage, getting new interest rates. And we're a highly indebted country, and that can amplify the pain. Now, if there is a global recession, I would not be surprised if the interest rates come down, but you still need the job to pay for the mortgage, right? So this is where we really have to watch over the job market, and which is what a lot of people have been watching out for, and why interest rates are still going up, because jobs are still readily being taken, and the immigration is not helping that, right? So this is all Lau said in his interview. Now, that's not something they have in their forecast, a recession. Whatever. Our forecast, which we think is most likely scenario going forward, is that we actually have inflation coming back down, which is fine, modest positive growth for the next year, and then growth actually picks up. But particularly when you're thinking about financial stability issues, you have to think, what are the tail risks? Tail risk is just a probability, right? So if you can think about the tail risk, which I would say some kind of external shock to Canada for the recession, I don't know how they can plan for it, but this is probably one of the reasons why they kept raising the interest rate, because if there is some tail risk and, something blows up, right, financially in the system, they have the ability to cut interest rates back down to like 0.25, right? And trust me, although that may sound good to a lot of people in the real estate world, for kind of like investors or something, keep in mind, if we have to cut rates back down to that, that means we had some kind of like pandemic level event, right? And we don't want that. Anyways, the last thing that I found very important is, this is a very interesting perspective that he has on the housing market. So when he was asked, do housing prices need to come down to hit the inflation target? He says, the fundamental issue in the housing market, and this has been an issue in Canada for 10 years, at least is structurally the demand for housing is growing faster than supply. Does he sound like a real estate bull to me? He's basically saying that the amount of demand, immigration that's coming in, which he doesn't control, by the way, right, is outpacing the supply, the pace at which we grow. This is the head of Bank of Canada acknowledging this. And yes, interest rates go up, the housing market will slow, but it's only going to slow so much because there is a sort of a structural shortage of supply relative to demand. And this is what I've always been saying. Short term, we got to watch the inventory, see what's going to happen, right? Medium term, watch the rates. Long term, the fundamentals of the population and us not building enough because of all the red tape is going to cause a shortage of homes, which drives up the prices. And that's been my philosophy for all the almost like decade I've been investing. So he is acknowledging this right now as well, which I found incredibly funny when I was reading through this article. I was like, okay, sure, be public about it, right? So this kind of gives us an idea of like, his perspective into what he looks at in terms of the market. And he actually answered a lot of the questions that I think most people would have for him. And I think the Globe and Mail did a really good job asking those questions, because now that we see his perspective where things are, it's very obvious that one, he is trying to get inflation down to 2, but I don't think he's even thinks he could probably get it, because he says that's going forward hover around 3%. The last little bit I told you, he thinks that there's a huge supply and demand imbalance on top of that. And he also doesn't think the amortization from 2025, 2026 years renewal is going to affect the market that much. So this is the Bank of Canada, Tiff Macklem, saying all these things. Take this information however you want to digest it, but this is his perspective. I've added a little bit of commentary, and you know what? Some of it is very fair. I don't think he has an easy job, but ultimately I think he's doing okay. I feel like his one, downfall was him saying that, hey, go buy whatever, interest rates will stay low until the end of 2023, right? It's almost kind of like if you compare LeBron James, his one fault in his moment was making that decision, right, to go to Miami and publicizing it. And I feel like this is kind of similar to him for any kind of basketball fans out there, right? But ultimately, I think he's doing a pretty good job trying to, skate between kind of two very, very thin sheets of ice and trying to land this plane that is the economy in Canada right now. So while there's a lot of pain right now, I think we as individuals have to manage our own cash flow and our balances to make sure we survive all this, because even Tiff Macklem is saying that there is a supply shortage, and we know what that means in the long run. Whether you can hold on to your assets long enough to reap the rewards of that, we have to determine. And if you want to determine what your cash flow and your balances and how to survive is, you can book a call with me using the link that's right here to kind of look through your portfolio and then analyze it. And the link is right here at www.chatwithzen.com. Until next time, your move, your future. See ya. Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?